Testing, testing. Hey, hey. See a couple of you guys tuning in. Are you guys able to hear me clearly? Right. Are you guys able to hear me clearly? Are you guys able to see the screen clearly? Right. Just checking and tuning in a couple of places. Um YouTube. Okay, are you guys able to see and hear me clearly? Let me enable the chat for everyone. I realized I kind of forgot to enable it. All right. I'm gonna send a message to you guys. Are you guys able to see the message that I just sent? Right, it should be in this thing in this place called like webinar chat, right? So that is the one which I'll be monitoring very closely, right? Yeah, okay. William, enjoy. Nice to see you. Maria, nice to see you loud and clear. That's great. That's great. We just got a mic upgrade, so you guys should be able to hear me quite nice and clear. Nice and clear, hopefully. All right, so yeah, what I want to encourage you guys to do is that when you are sending messages, right, um the drop down, can say is to everyone or to hosts and panelists, right? Feel free to send it to everyone so everyone is able to hear to see your messages, because sometimes when I'm answering questions, right, if you send it only to me, the other people in the chat might not know that might not know the context of your question, right? So feel free to really send it to everyone, right? Not just me. Okay. Now, good stuff, man. Good stuff. Nice to see everyone tuning in, right? May I know where are you guys tuning in from? Which countries are you guys tuning in from? Can you guys share with me? Right. It really helped me a lot, right? To know the audience, right? Where you guys are tuning in from. Just need to refresh my trading view, make sure it works. Um, I've got a lot of stuff to cover today. Really exciting stuff, interesting stuff that we're going to take a look at. All right. Now, okay, we got a couple of people from, well, okay, England, Hong Kong, Netherlands, Greece, Ghana, South Africa, Germany, right? Germany, UK, London. That is great. I'll be going to London in next year September, right? I heard that yeah, there's a little bit of stuff to do there, right? There's a little bit of stuff to do there. But hopefully I can watch a soccer match. Although I heard it's like impossible to get the tickets there, right? I'm gonna watch like a Manchester United match or something, right? The last time I went there, like 7 years ago, right? The tickets were all sold out, so I had to go to a pub to watch it, right? So I kind of want to experience the real atmosphere of being in a one of the stadiums that you guys have. It's pretty cool. Right. I actually got a couple of you guys from UK, London. It's great. Switzerland too. Very, very nice. Highest standard of living in the world. Good stuff, man. Right. So without further ado, let's begin today's session, right? Today's session is a 3-part series, okay? The first part is done by me, right? And it's going to be on mastering Fibonacci retracements and extensions, right? So I personally use this trading strategy a lot, right? My trading strategy is scalping, right? Really profitable trading strategy, really effective trading strategy, but a lot of effort is put into Fibonacci, mapping the correct Fibonacci, right? It is one of the few indicators out there, which is what I call a market leading indicator. A lot of stuff that you see out there, they're kind of like they're lagging indicators, right? What I mean by they're lagging indicators, it means that they are always one step behind the market. Okay, they're always one step behind the market. You have a well, just let me move my screens around here. Yeah, so the lagging indicators basically are like a moving average, right? Your oscillators, right? Your stochastic, your RSI, right? Those stuff are usually one step behind the market, right? And by the time you want to act on the information that you see, you're always kind of a little bit slow. You're slow to the party, right? So Fibonacci is one of the very, very few technical analysis tools out there, which is actually a leading indicator, right? It tells you at what point the market might reverse from, right? But it only works, right? It only works if you use it effectively, if you use it correctly, rather, because a lot of people do not know how to use Fibonacci, don't know how to draw Fibonacci correctly, right? And they draw it wrongly, it doesn't work, and they say like, yeah, this thing doesn't work. But the truth is that if you know how to use it, draw it properly, right? The trick is in the drawing. The trick is in the drawing. If you know how to draw it properly, it helps you become a much, much better trader. Okay, right? And today, the first of these sessions, I'll be really diving deep into looking at the proper market structure. What are the important ratios to look out for, right? Fibonacci kind of operates all in the form of ratios like 23, 38, 50, 61. These numbers, they might seem a little bit alien to you guys, but yeah, it's all there's meaning behind every one of it, right? And there's an approach that you should use when you're using Fibonacci to trade. Okay, the first part series is done by me, right? And the next two-part series is done by the rest of my team, right? And they'll be taking you through Fibonacci expansions and Fibonacci projections. Yeah, you heard me right. There are quite a number of different ways that you can use Fibonacci, but they all are used together, right? They all are used together, right? It's just that today we're having a deep dive into the entire spectrum of Fibonacci. Right? A lot of people are like, yeah, Fibonacci retracements, but yes, there's Fibonacci retracements, Fibonacci extensions, Fibonacci expansions, Fibonacci projections, right? We don't go into the craziest stuff like the Fibonacci wave, the Fibonacci spiral, right? That stuff, we haven't really looked into it yet. Rather, I feel like what we're going to teach you should be enough to take you through it. Okay. Now, of course, disclaimer for today, always remember that everything in this webinar is educational in nature. So nothing should be construed as investment or trading advice. So please do your own little due diligence before you guys trade, okay? And what I want to encourage you guys is that, yes, we have literally, I literally have two screens here, right? One screen just monitoring the chat that is coming through. So anytime you have questions, what I really want to encourage you guys to do is send it right through. Okay, I will look at it. I'll look at it, and if it is relevant to what we're covering, I will try to respond to it as quickly as possible. Because trust me, we will not have time to for any Q&A towards the end of this session, right? So anytime you encounter a jargon in a particular term, right, something you're not too clear about, just don't hesitate, send it in, right? I'll do my best to answer them if it's relevant. All right. Okay, right. Now I see one of you guys enabled closed captioning. Awesome, right? I hope the translations are okay. I'm not sure how good my enunciation is when it comes to English. So yeah, so I hope it's okay. All right. Now, everything in this webinar is educational nature. Nothing should be construed as investment or trading advice, guys. Do your own due diligence before you guys trade. Now, let's go. And introducing your host for today, that's me. That's me. I'm pointing the wrong direction. Yeah, that's me. That's bigger me, right? I'm mini me here. All right. Name is Desmond Leong, right? So I run the award-winning research firm Everest Fortune Group and also the Forex Army. All right. So we're finalists for 2019, 2020, and 2021 for best FX and best equity research. Now, usually work with major financial institutions out there, helping them forecast where the markets are heading. So we have a special partnership with Vantage Markets where we're bringing you guys the good stuff, the juicy stuff, the stuff that take a trading to the next level. Right, it's a three-part series. Every Monday we look at the markets. Right, we forecast what's happening for the markets for the rest of the week. Key news items to look out for. Every Tuesday, it's an educational series like today. Right, and every Thursday, is a trading strategy clinic. Right, it's exclusively for Vantage Plus. Sorry, Vantage Plus. Right, and that is where you come in with your trading strategies and you show it to us and you say, hey, what's wrong with my trading strategy, right? How can I improve on it? How can I make it better, right? Where are the potential loopholes that I'm missing, right? And in the trading strategy clinic, as the name suggests, is where we help you diagnose it, right? Like, hey, yeah, perhaps you should focus less on like momentum indicators, try to throw in a little bit of a blend of oscillators, throw in a little bit of trend lines, right? And then maybe throw in a little bit of correlation. So yeah, we really help you diagnose your strategies every Thursday. Go check it out. All right. So anyway, that's a little bit about me. I keep pointing wrong direction. It's the thing is flipped around here. So that's me. That's me. Yeah. All right. Okay. That's me. Okay. Now let's move on from here. Anyway, if there's one bit of encouragement I want to share with you guys. Yeah, I look really young. Oops, sorry. I look really young and I am really young, right? And if there's any word of encouragement I share with you guys is that it doesn't take 30 years, to be a good trader. It doesn't take 30 years in Bloomberg, to be a good trader. right? It doesn't take a CFA, it doesn't take a CMT, it doesn't take a master's in financial engineering to be a good trader, right? All you need to do is to spend 30 days learning the right stuff, learning from the right people. Because the funny thing is, right, in trading, the world of is very different from the world of academia, right? It's very different from the world of academia, right? In trading, right? Actually, I can expand myself here, and there we go. So I'm just talking over here. If you can, in case you guys can't see me, I'm a little bit small down here. I'm just going to expand myself a little bit, right? Because I just want to share with you a quick point over here that to trade well, you need to detach your mentality away from the world of academia. Okay, what do I mean, right? In the world of, sorry, just need to hide, where's my chat thing pop up here? Yeah, the world of academia, right, teaches you that the more you study, the better you get at trading. Okay, the more you study, the better you get at, the more you study, the better you're going to do in an exam, right? You know, we've been through those examinations. You know, you study for an entire year, right, to take an exam, right? If you don't study, you don't do well, right? So there's a positive correlation, right? That means the more you study, the better you do. The harder you study, the better you do. The more books you read, the smarter you are. Okay, so that is that little positive correlation, right, between the world of academia and and results, that we're very familiar with. But in trading is very different, right? It does not mean that the more you study, the better you do. Okay, sometimes the more you study, you end up studying the wrong stuff, right? And then you study about RSI, you study about stochastic, you study about MACD, and you use all of them together, and you're thinking that you're going to be a profitable trader. And what you've just done is that you've loaded too much of your strategy on oscillators. And even though you studied more of these indicators, you apply it together and you end up losing more money, right? Because you get a false sense of confidence that you have stochastic says it's overbought, RSI says it's overbought, MACD says it's overbought, so it's going to drop, right? But of course, right, that's not how the market behaves, right? You can, the worst thing about trading is that you can study the wrong stuff, right? And one of the sayings that I really like is that you can run full speed. One of the worst things to do in life is that you can run full speed in the wrong direction. Okay, that's running full speed. Everyone's going one direction, but you're going the wrong direction, right? So you want to avoid that. And to avoid that, you need to learn from the right people, right? In this case, right, have good partnership with Vantage Markets. We're teaching you the good stuff, right? You can learn from us. Best thing is that, you're not required, we're not selling you any courses, and just here with a special partnership from Vantage to teach you the right stuff. Take the opportunity, ask us as many questions as you want. All the questions that you've held up, you've been thinking, you've been wondering whether, is there a proper way to implement it in a trading strategy? Feel free to ask it to me. I'll give you my opinion on it. I'll hopefully point you in the right direction, right? And yeah, so that's that little bit of encouragement I want to share with you guys that, in trading is very different from studying, right? It's not how much you study. It's not how many indicators you learn. It's not how many studies you apply, right? It's applying the right things, okay? Applying the right things at the right time, at the right markets, with the right strategy, okay? It's very simple. Very simple. Now, let's begin today's session. I'm going to shrink myself to mini me again, right? And let's go. What is our agenda for today, right? So we're going to look at Fibonacci retracements, right? I have a handy dandy little tool I can use to draw on the, I'm going to use this. Give me a second. Yeah. There we go. Okay. Yeah. So we're going to look at Fibonacci retracements, right? Fibonacci retracements. What are the important ratios to look at? We're going to look at extensions, right? So Fibonacci retracements and extensions, they both use the Fibonacci retracement tool. Just that they have different interpretation, right? One is from 0 to 100%. I'll be showing you what this means in a minute. And one is anything that is above 100%. Okay, so that is different, same tool that you're using, but just different interpretation. I'll be showing you ideal market structure. What's the kind of market structure you want to look out for when you're trading. And then, of course, you go in, if you have the time, we're going to look at intensive practice session, right? I'm going to look at some, try to give you guys a couple of quizzes to see whether you know how to really interpret Fibonacci levels correctly. Okay, now let's move on from here. Next slide. Ideal market structure. Okay. The first and very most, I would say very most, the first and most important thing is that you need to look for the correct market structure. You need to look for this thing called significant swings, because significant swings is where you're going to take your Fibonacci starting and ending points from. Okay. When I say significant swings, what does significant means is that it must look big, right? It must look big. It must look nice. Okay. Just let me move my chat over here. Oops, sorry, over here. Yeah, it must look big. It must look nice. Okay, so, these are really, really tiny little swings, these are small things. And so these are, these are bad. They are bad, they're bad to use for Fibonacci points, right? Ideally looking for the bigger ones, up, down, up, down, up, down, looking for the bigger levels, bigger swings. What does that mean, right? Let me show you. Okay, so these are significant swings, right? As you can see over here. Where's my mouse? Very big up, very big movement down, very big movement down, very big movement up. Looking for the key levels. You're not looking for the tiny ones over here. Looking for the big ones, okay? The big ones help you find the starting and ending point of your Fibonacci much better, okay? So what you're going to look for is significant swings, okay? Always remember, when you're drawing a Fibonacci, the starting and ending point of a Fibonacci, look for significant, right? Significant. Now, next point, right? This is an example of significant swings, right? So in this example, I'll be taking my Fibonacci from here all the way up to here, to my ending point over here, because I got one significant swing low here, I got one significant swing high over here, right? So it's a perfect time to draw Fibonacci retracement from the bottom to the top. Live examples of how we do that in a bit, but this is exactly what I'm looking for. You notice I don't go for the tiny. I don't go for the tiny levels over here, over here, over here, over here, over here, over here. I don't go for those tiny levels. I go for the significant ones. Okay. Now let's go, right? Next thing you know, right? So we already say significant. Sure, yeah, you find significant swing low here. Where's my mouse again, man? A significant swing low here, significant swing high, significant swing low, significant swing high. You clearly identified a pretty good market structure, right? So as what we mentioned in the previous rule, finding significant levels, right? You have found it, but the next thing you need to do is you need to follow the price structure. Okay. Now you notice when we draw a Fibonacci retracement, there's this thing of Fibonacci trend line. Can you see this little line in the middle that goes all the way across? It's a little dotted line. Right, it's a little dotted line. Can you see? I'm going to draw it again. Right, you can see it over here. It's a little dotted line that goes all the way across. You can see it over here. Right, so that is what we call the Fibonacci trend line. Right, the problem with this is that it cuts through the market structure way too much. Now, this is my favorite part. I'm going to pull up some charts. Okay, so we're going to look at it over here. Like, I'm just going to throw on the chart over here. Bam. Remove this. I'm going to hide this. Okay, it's a chart on gold. Okay, it's a chart on gold. So you can see the market. Let's start looking at market structure. Okay, you got movement down, up, down, up, down, up, down, up, down. This is the market structure, at least for the move over here. I will not take a Fibonacci retracement. So, okay, this is on the 1 day time frame, right? I will not take a Fibonacci retracement, for example, from here to here. The reason for that, right, I'm just going to make it really clear for you guys, right? We got a movement down, up, and down. Okay, if I take a Fibonacci retracement from here to here, okay, what happens is that there is such a big space. Can you see? There's such a big space over here, right? There's this little what we call Fibonacci trend line, as you can see, right? But then price deviates from this trend line a little bit too much for my liking. Right, price deviates from this trend line a little bit too much for my liking. I'm going to move myself. I'm going to move myself somewhere. I'm going to move myself here. Okay. Yeah, I'm going to move myself here so you can see a little bit clearer. I just noticed, right, that I'm a little bit blocked out. Where am I again? Where am I again? Sorry. I can already see a question from Wayne asking, what is the best time frame to use for Fibonacci? Personally, I don't go below 30 minutes. right? Every time frame is good. 30 minutes, 1 hour, 4 hours is good. 1 day is good. Now, Fibonacci is not good on the lower time frames. I will explain why in a bit, right? And it actually has to do with the differing prices on and how much price weeks on the lower time frame for the forex pairs. Okay, so in this example, we're using 1 day time frame. Now, what I mean by prices, to answer the question, Wayne, is not only the time frame, is the instrument too, right? So I'm gonna come here, right, and I'm gonna load my little watch list called Desmond Scalping List. Now you notice I have this little list here called Euro Kiwi Precision, right? The reason why I have a list called Euro Kiwi Precision, and this is, we got a price sheet from Oenda, we got price sheet from, I don't know, everywhere. Every single broker I got a different price feed, right? Let me show you why. Okay, let me show you why. So let's just say we are on the 5-minute chart, trying to map. We're trying to chart on the 5-minute chart. Okay, let me see if I got some examples over here. You notice as I'm changing, right? The charts, like for example, this chart on Euro Kiwi, my low point, maybe my low point is 1.6886. Okay, 1.6886. What about this? This is 1.6884. What about this? 1.6885. What about this? 1.6888. Right? What about this? 1.6887. Wow, look at that, right? We got each of this has a different low point for me to use. What about this, right? I'm just going to show you some examples, right? This is 1.687, right? Let me see the last one here. I think the last one should be fine. 87, we got 87, we got 88, 84, we got 85, we got 88, we got a couple of different price feeds. Now, this is just the nature of the forex market, because the forex market, right, we don't have a centralized exchange, meaning that each broker has their own price feed, right? And this price feed differs a little bit from each other, right? But it differs the most on such instruments such as crosses, Euro Kiwi, for example, Pound Kiwi, Euro Aussie, right? These are what's the word for it? Minors. These are crosses. We're not exotics, more minors and crosses, right? And the price feed differs a bit. Now, what is the problem with price feed differing? Right? What is the problem with price feed differing? Right? Is that your starting and ending point of your Fibonacci is different, right? So now let's come up here, right? Let's come up to here. I'm gonna remove this, right? And our starting point of Fibonacci, we can take it. We probably can take it from here, okay? Now, let's see how it differs from broker to broker, okay? We got this over here. This is 1.7208, okay? I'm gonna come to here. What about this? 1.7208, okay, it's fine, it's fine. This one, 7209. This one, 7208. All right, actually kind of looks, this could be okay. This is, oh, sorry. This is 7204, right? One was 7208, one is 7204. This is 7208 also. Oh, wow, this one don't even, what's this? This is 708, all right. This one looks a little bit wonky. Yep, and this is probably 7209, more closer to 7210, right? You got 7208, 7204, 7210, right? And you see the problem there is that different brokers, different time frames, right? So a long answer to your short question, Wayne, right, on what's the best time frame to use for Fib, right? First, you want to use a higher time frame. Second, not only the time frame, but the instruments that you want to use on, right? You probably want to use on instruments which are a little bit less minor, right? You want to avoid the crosses a bit, right? You want to kind of look for more of the majors, those that have a little bit more liquidity. Okay, now just look at this chart over here. What is this movement over here? This movement is missing on this broke over here, right? And then there's a different movement over here. That thing doesn't even exist over here, but look at these crazy wicks over here, right? This one has no wicks, but it's the same, it's the exact same thing you're looking at, a lot more less fluctuation. Just look at these two. One is like this, one is like this, right? And it's because of the different price feeds that you get from different brokers. Okay, Vantage has a great price feed, right? Vantage has a great price feed, right? But the nature of Fibonacci is that nature of technical analysis is that you need to, the more people who are looking at a certain technical tools, right, the higher the chance of it being correct, of it working. Okay, so if that is okay, if everyone uses Fibonacci, is okay. But the problem is that when you're drawing Fibonacci, and in this example, right, because your starting and ending points are different, right, from here to here or whatever it is, right, because you have one guy starts here, one guy starts here, one guy starts here, one guy starts here, one guy starts here. Your the values that you derive at the end are different, right, and becomes less effective, right? So a bit of for those of you guys who have been using Fibonacci, who have been maybe struggling with Fibonacci, right? The trick here really is to fine tune your analysis. Don't go crazy analyzing every single instrument out there. It's perfectly fine to just focus on those instruments that are the majors, right? Focus those instruments which are a little bit more liquid, a lot less fluctuations. How do you know if there's fluctuations? This kind of crazy wicks, these are signs of fluctuations, right? These are signs of fluctuations. And what I always like to do, right, is that I have so many different prices over here just for me to cycle through. If you use TradingView, you just press space, right? So what I like to do is I like to press space and space and space. And if I'm looking at it, I'm like, holy smokes, man, each one looks a little bit different, right? Then I know that, right, it's a little bit dangerous for me to use Fibonacci on this pair and on this time frame because they're a lot less effective. Now the trick here is actually on the higher time frames, they tend to behave a lot better on the higher time frames. Now look at this, right? This is on the lower time, this is on the higher time frame. As we toggle through, you notice that just let me erase all drawings. Erase all drawings, right? As we toggle through, you notice that here we go. As we toggle through, yeah, I notice that the chart kind of still changed a little bit, but the overall structure is about the same, because the truth is 5 pips on the 5-minute time frame is a lot more significant than 5 pips on the 1-hour time frame. Okay, let me show you what I mean, right? If we are on the 5-minute time frame and we're analyzing, right, let's just say a little bit of difference in our I got price range from here to here. Maybe this is, let's just say some of them have a difference of 10 pips, right? It looks like this much. Look at this, right? It can alter your ending point pretty significantly, right, on 10 pips over here. But if you go into like the 4-hour chart, that 10 pips, you can't even see it down here. And this is the 10 pips down here. On the 4-hour chart, is even on the 1-hour chart, you can barely notice it. But on the 1-minute chart, you're like, holy smokes, it's so huge. This is going to affect my analysis, right? But yeah, it's because it's on the 1-minute chart. Even just load the 1-hour chart, that big movement, now you can't even see it anymore. You need to zoom in, zoom in, zoom in, zoom in, zoom in until it's right down here. Then you maybe notice a small little tiny dot down there, right? So the higher time frame, that's why I like to use slightly higher time frames when analyzing Fibonacci, because there's less room for pricing miscalculations and inaccuracies. All right. Now let's move on. Okay. Sorry, I digress quite a bit. I'm gonna pull up my slides over here. Oops, not this one. Right. I think I need to minimize this. Yes. So price structure, I just explained to you guys. Okay, this is the correct way to follow price structure, right? So you can see over here, right? There's a Fibonacci from here to here, very clean. There's another Fibonacci from here to here, very clean, right? It priced even though, right? Where even though THOU, right? Even though the second Fibonacci retracement cuts through this little zigzag quite a bit, right? It still doesn't deviate too much from the price structure, so it's fine, right? Notice that it is still pretty close to it, so it's fine. Okay, what you don't want is you don't want your price structure to be like that. Oh, sorry, no, price doesn't go up, right? You don't want your price structure Yeah, price structure to be like that. And your Fibonacci retracement. No, actually, this is fine. You don't want it if it's like that, right? You don't want too big a gap, as you can see over here. The bigger the gap, the less accurate it is. Okay. Now, so let's go. So this is the correct way to the correct price structure, right? So these are different Fibonacci retracements there. I am going to move myself again. I can't move yet. I can go lower, right? So you guys can see it. I'm going to move myself again. Where am I going to move myself this time? I'm back here. Okay. Now, so yeah, the different Fibonacci retracement levels to kind of look at, right? We have the 23%, the 38, 50, 61, 78. Some people use like the 13 or 14%. Some people use the 88%. Some people use 76.4%. But from my experience, right? From my experience, on like years and years of using Fibonacci, right? It tends to be 78.6 more than 76.4. These are the important Fibonacci retracement levels to look out for. We got VJ, right? Saying, can you go back and explain about what you mean by you don't want big gaps? Okay. So we got VJ asking me what I mean by we don't want big gaps. Let me just use one example over here for you, so you don't get lost. Okay. Now, this is a good example. Now, as you can see over here, market structure. Okay, I'm going to give you guys an example, right? So this is a nice swing high, down, up, down. Okay. Fibonacci retracement. Which one is better? From here to here, this is option A, or from here to here, option B. This is option A, this is option B. Which is better? Guys, can you guys share with me, like, which you think is better, A or B? Okay, I can still see Kin saying A. Please, guys, please type it in the chat so I know you guys are following me. Actually, we got quite a, we got Nicola actually says A, Jeremiah says B. Okay. Okay. Joanna says she likes neither. Okay. Now, trick question. Both are terrible. Both are a little bit terrible. And the reason for that is because there's a part C over here, right? Part C is where you're taking this and you're following the market structure right away. Now, let me erase all this and show you what I mean. The reason why A cannot work is because of this, right? This is what I mean by the big gap. Okay, there is a gap over here. Can you see this little trend line in the middle? There's such a big gap between price structure and Fibonacci and the Fibonacci trend line. That's a big gap that you're looking at. Now, how do I show the gap? Maybe I go a line chart, right? Maybe line area dash, all terrible. Bar, nah. Candles are fine. Candles are fine, right? That's a big gap. Okay. The second problem with this one, right? The option B was that there's this actually big movement down here, up and down. Now, it's a little bit of a trick question because if you look at the 30-minute time frame, this is really terrible. This is really terrible, right? So Joanna actually did raise a good point that, it's you ideally want to follow this to this. Really nice and clear. Fibonacci retracement, and you go all the way, and I'm going to zoom in for you. I'm going to zoom in, right? Can you notice how nicely price follows this Fibonacci trend line? Okay, oops, I clicked something. Yeah, it follows the Fibonacci trend line very nicely. And because it follows it so nicely, it's more effective, right? It's better. If you had taken it from point here, which is what I did earlier, right? So there we go, right? I take a Fibonacci retracement from here down to here, right? It looked okay on the 1 hour chart when I was like looking at it like that, right? But yes, it's a trick because if you look at it on 30-minute time frame, you zoom in a little bit and you realize that price actually deviates pretty far, pretty far from price, right? Over here is still kind of okay, but this much deviation isn't very good for it. And that is what I mean by the big gaps that you want to avoid. Okay, guys? Now, back to the topic. These are the key Fibonacci retracements you want to look at, right? Now, as you can see, this is very simple. Just have a nice starting point, nice ending point, right? When you draw Fibonacci retracement, you're going to notice that there are a couple of levels, right? There are the negative ones, right? You're going to use a Fibonacci tool. Fibonacci retracement tool is the same tool that you're using, okay? It's the same tool. But from the Fibonacci retracement comes three things. You have your standard ones in the middle. Your standard ones in the middle are between 0 to 100%. These are called Fibonacci retracements. You have those that are in your negative region. Negative region will be covered in the next webinar. This is negative 61.8, negative 27.2. These are Fibonacci expansions. Then to make you even more confused, right, we have Fibonacci extensions. And these Fibonacci extensions are those that are above 100%. Right, these are called Fibonacci extensions. All right. And, they all use the same tool. They all use a single tool called Fibonacci retracement. Just that whether you are below 0%, you are from 0 to 100%, or you're above 100%, they all have different explanations, different ways to use it, and of course, different names. Okay, so this is a very important point when it comes to understanding Fibonacci retracements. Fibonacci extensions, right? Three levels that you kind of want to look out for. Actually, this is 127.2, you got 138, and you got 161.8. Now, the thing about Fibonacci extensions, right, which I want to give you guys a nice little tip, just to get the hang of it a little bit better, is that you want to look out for this thing called the Nike tick, right? I'm not sure if you guys are familiar with this brand called Nike, right? The Nike has a nice little Nike tick, right? You're looking for a really nice Nike tick over here. You're not looking for ASICs. What's ASICs design? Oh man, I don't know how to draw ASICs, right? So, maybe Adidas. Oh, kind of forgot how Adidas looks like either. Yeah. I only know Nike. Yeah, so you're going for a Nike tick, okay? You want to look out for a Nike tick because your start of your Fibonacci retracement is here. Your ending is over here, right? Price is going to retrace 23, 38, 50, 61, 78, 100%. And once it reaches the 100%, this is where it goes to this 127 over here, right? It goes to 138 and it goes to 161. It keeps going up, okay? Right, but because it's above 100%, as you can see, right, they're all above 100%, it needs to retrace a full 100%. This letter V over here that you see, right, a nice little letter V, this means this is 0, 100. No, I mean this is 100, 0. Price retrace 23, 38, 50, 61, 78, 100%, right? Once it reaches 100%, then it forms a V. Only when it goes beyond the V, that's where it becomes 127. It goes a little bit higher, it becomes 138. It goes a little bit higher, it becomes 161. And then you notice it's a Nike tick that you're looking at. Not those fake Nikes, right? But the real ones, right? Why the real ones? Is because you don't want something like that, right? You don't want something like that, right? You want a very clear movement. So for Fibonacci extensions to work, the clearer the movement, the better. Excuse me, I need to take a quick sip because I tend to talk a lot, right? So yeah, Fibonacci extensions, look at this, right? Starting point, ending point. Starting point, coming down to the ending point, right? And you notice, right? We got the 127 and we got the 161.8, right? You look at price coming up, coming up, coming up. It touches this level over here, right? And we expect prices to reverse, okay? And price goes down, it goes down, it goes down, right? It keeps going down from there, right? But first, it needs to be able to touch, it needs to hit the 127, the 138, or the 161.8. These are the three big Fibonacci extension levels to look out for. And very simply, try to look out for them in the form of a nice little Nike tick. Okay, like as you can see over here, a little pro tip that we have: look for a Nike tick to find these very powerful setups. Okay, now moving on from here, let me see. What you want to do is this thing called Fibonacci confluence. Okay, some advanced concepts I'll be teaching you in the next 2 webinars. Fibonacci projections, right? You find one level over here. Fibonacci retracements, right? You find a negative 27% over here. Then you got Fibonacci extension. This is a reverse Nike tick that comes down to here, right? So you got 3 levels that line up over there. And what we then do is we highlight the entire area as a potential area of confluence, right? What happens when price sees confluence is that, it goes down there, it touch it level, and then it bounces up very nicely. Okay, bounces up very nicely from there. Oh, I might need to erase my drawings a bit because it's blocking. Man, is this the one? And this is the one. Erase all ink on slide. Okay, yeah, there we go. Right, so it's it's for you guys to take a look at, right? But yes, ultimately, you're trying to find an area of confluence to look for the bounce. Okay, so yeah, this is how you use Fibonacci confluence, right? So this is the different Fibonacci levels, right? You notice that I draw one from here to here, right? The 1 to 7 levels, are those that are above 100%, right? And then you have the negative Fibonacci retracement that are below 0%, right? So this is how, I drew it from here to here, rather here to here, right? So if it comes all the way up to here, this is a nice Nike tick, right? There's another way that you can use negative Fibonacci retracements, which is called Fibonacci expansions, right? But it requires this thing called a Harry Potter kind of scar. They'll be covered in the next 2 webinars. I don't want to confuse you guys too much today as we go a little bit too advanced. Okay. Now, okay, that's good stuff, man. This stuff. Let's move on from here. Let me find my handy dandy little thing here. All right, so this is an example, right? This is an example of how you can use, in this case, Fibonacci expansions. You're looking for a nice little zigzag, negative 27%. Price touches it and it comes back to its level. This by itself is what I call the Harry Potter trading strategy, right? Why is it Harry Potter? Because take note of this little pattern over here. This little pattern, right? This little pattern looks like, as you can guess, Harry Potter scar. There you go. Harry Potter scar over here, right? Yeah, I think it's this one. Yeah, Harry Potter scar. I said it's a little bit off, but that is what you're looking for, right? You're looking for the Harry Potter scar. And it's a pretty good trading strategy. Okay, you're taking the trade when price hits the negative 27 and then playing a bounce off, right? It works a lot better when you combine Fibonacci confluence, like I showed you previously, right? Over here, right? You use Fibonacci retracements, you use Fibonacci extensions, you use Fibonacci projections. The more things you use, the more things that line up, the better and more the higher probability that price will bounce off your level. Okay, now, bam, bam, bam. Okay. Now, this is the Nike tick that we're looking at, which a little bit simpler explanation. Right? You can see you're looking for the market structure to be very, very similar to a Nike tick. Right? You're looking for 161.8, you're looking for 127.2. I think also over here where you're looking for a quick reversal. Yeah, not necessarily, the reversal does not necessarily need to be such a big reversal. You're usually looking for a small reversal, just scalp that reaction, right? Called a reaction trade, right? You just want to play the reversal off here. Maybe from here to here is enough. You don't need to call the Hollywood trade all the way down to there. Now, why is that the case, right? So, now guys, participate with me, all right? So if you're looking at a weather forecast, right? If you're looking at weather forecast, okay, let me just, and you have a 1-day forecast, you got 1-day forecast, you got a 1-week forecast, and you have a 1-hour forecast. Which would be the most accurate? You're looking at a weather forecast that says it's going to rain. One of it says it's going to rain in 1 hour. One of it says it's going to rain in 1 day. Another says it's going to rain in 1 week. Which is the most accurate? Well, Wayne says 1 hour, VJ 1 hour, Joanna 1 hour. Joanna also says 1 day. I mean, this another Joanna 1 hour. But most of the guys are answering 1 hour, and with good reason, right? Because 1 hour is within our locus of control. We know what's going to happen in 1 hour. We know that the world is not going to collapse in 1 hour. We know that Trump is not going to be let back onto Twitter and, go ahead and tweet crazy stuff in the next 1 hour. That might happen in the next 1 day. It has a higher chance of happening in the next 1 week, right? But this is this thing called locus of control. This is you. This is you. You want to have a close locus of control. If it's 1 week, your locus of control is too far away, right? You're not in control of things, right? So that's the same thing when it comes to trading, right? In trading, we know that there's a high chance price might make a small little reversal over here. Small little reversal over here. So this is like the 1 hour forecast, right? But there's a lower chance of price going all the way down to here. This is like the 1 week forecast. It's very far away. A lot of things can happen. You can be correct 90% of the way. You can be correct 90% of the way. Then, a big news happens, right? And then price goes in the other direction, right? So when it comes to trading, you want to be as close. You want your trading strategy to be as close to your locus of control as possible, right? The less you need to hold on to trade for long periods of time, the better, right? The more in control you are of things, the better. Okay, very, very important points to take note of, guys. Okay, now this is an example of Fibonacci confluence. Very simple. Got a starting point over here and an ending point over here. Starting point, ending point, starting point, ending point. Different 1 to 7, 2 for 1 is the advanced level 50. You got 3 of it that lines up very nice. You're waiting for price to come down and then bounce up, right? It's all about finding the confluence. Okay, it's all about finding the confluence. Okay, that is essentially how you trade, right? I have a little bit of time over here, right? A little bit of time to really go through some examples with you, right? Go through some examples with you when it comes to drawing Fibonacci. Let's use a couple of examples, right? Let's use a couple of examples. Now, when it comes to Fibonacci retracement, okay, when it comes to Fibonacci retracement, and now we're looking for resistance, right? Where is my starting point? And where is my ending point, right? I got my starting point here, A. I got my starting point here, B, C, and D. Okay, you're trying to find resistance. You're trying to find a level where price might reverse from. And you're going to draw a Fibonacci retracement. Do you draw it from A to B, B to D, C to D, A to C, right? Where is my starting and where is my ending point? You can answer in the form of like AB or BC or CD, right? Do you guys want to take a guess? Now I'm looking to sell. What is the answer, guys? We got Trung saying it's A to D. We got William saying C to D. Amor saying A to D, C to D. Mickey saying A to B, B to C, C to D, C to D, C to D. Right? Got a couple of you guys saying C, D. Right? Rajesh saying CD, Nicola, Vijay, all right, saying CD. All right, okay. Quite a number of you guys are saying CD, and CD is the correct answer. C to D, right? We can see that these are, very, very clear market structure over here, right? You can see this is the 23%, the 38%, the 50% retracements that they're all looking at, and you're looking to play a reversal from there, right? When another topic for another time, right? But yes, this is the answer, right? If you take a Fibonacci retracement from A to D, it's not that great. The reason why it's not that great, this part is still quite okay, but this movement over here is too big. It's too much space over here, right? And it makes your Fibonacci retracement less effective. It can still work, but it's less effective, okay? And that is why we don't use A to D, okay? Now, another question over here. Let me do another Fibonacci training session with you guys. Now, okay. We got Fibonacci retracement here, right? I'm telling you this is correct. 0 to starting point, ending point is correct. We got 23%, we got 38, 50, 61, and 78.6. Okay. Which Fibonacci retracement is valid for this example? Which Fibonacci retracement is valid for this example? You know, you got 20, just so you don't type out everything, you got 1, 2, 3, 4, 5. Not all of them are valid anymore. Which one is still valid? Can you guys take a guess? Right, we got some people say 78.6. We got some people say 61.8 is still valid, right? 78.6. William says 5. Yeah, 5. Which one is still valid? 5 and 2. Trung is guessing 2 is still valid, right? Don Hudson says it's 3. Rashina says it's 5. All right. All right, so we got a couple of answers over here. Now, here is the trick when it comes to Fibonacci. Starting point, ending point. You must imagine like Fibonacci as like this, right? Bar replace here. Joanna, we don't use 88%, right? You can use it, but I personally don't use it. Now, at this point, all of them are still valid. Okay, all of them are still valid. When price, where's my, is this forward? There we go. Forward. Okay. When price breaks this 23%, it has served its little purpose here. This becomes invalidated, right? All the rest are still valid, right? Goes on, goes on, goes on, right? It looks like it's holding at 38%, then it breaks it. Not valid anymore, right? And then it goes lower, breaks and breaks. It breaks 50%, it breaks 61.8%, right? So these are not valid anymore, right? And it comes all the way down to 78.6%. Now this is called a break, means it's not valid. Okay, none of the Fibonacci are valid anymore. So it's important. Sometimes people think that price comes back up to here, right? They think that, oh, it's the golden ratio, it's the 61.8. And also price comes down, it breaks everything, and it comes back up here. It's not valid anymore. The moment a Fibonacci retracement is broken, it's not valid anymore. It only works the first time. Remember, guys, Fibonacci is a leading indicator. If you trade it this way, right, where it comes back a second time and you use it, that it becomes a lagging indicator, right? It becomes a lagging indicator. It's not going to work anymore, right? Fibonacci is a leading indicator where it helps you project at what point of time price might have a small bounce, price might have a small bounce, right? But that's about it, right? To increase your chances of getting a good bounce, right? That's this thing called scalping strategy, reaction trade. Nike got this particular trading strategy where I can teach you guys how to use it effectively. But that is essentially what Fibonacci is, right? You can only use it the first time price reaches it. You cannot use it repeatedly. Once it's broken, it's broken. So Miki is asking what's the meaning of the golden ratio. Golden ratio, right? Fibonacci, when you draw, there is always a golden ratio. 61.8 is a golden ratio. It does not mean it's the most effective. It does not mean it's the strongest, right? It just means that, right, it is the golden ratio, right? All of these Fibonacci levels are not strong. They're only strong when they are combined, right? They're only strong when they're combined. Very important. They're only strong when they are combined, guys, okay? But this is a strategy. I'll teach you guys this Nike tick strategy in the future, right? But yeah, Fibonacci ratios are only strong when they're combined. Bulo is asking, right? When Fib is broken, when can we use it again? When Fib is broken, you can't use it again. Okay, it's like a glass. It's like glass, right? It's broken, you can't use it. Rashina is asking, right? How do you know when to use Fibonacci? You can use Fibonacci mostly for reversals. Okay, when you're using Fibonacci, you're looking for reversals. Like for example, from here to here, if you're looking for Fibonacci, right, whatever strategy that you have, right, Fibonacci is very good in forecasting where the reversal might happen, right? It's not so good for breakouts. It's better at forecasting at what pinpoint level a reversal might happen. Okay, another one over here, maybe from here to here, right? From here to here, right? You can see the reversal happened just about at the 50%. Fibonacci is used for reversals, okay? It is best when it's combined. For example, let me see over here. Let me try to find an example for you guys. Okay. Let me show you an example over here. Okay, maybe in trading, right? In trading, replay feature. In trading, okay? You're trading this currency pair, euro dollar, and you highlight this level. I'm going to use a 2-hour chart so it's a little bit cleaner, right? And you highlight that this level is an important level over here. Why is it an important level, right? I'm going to highlight this area. I show you how I kind of use it myself, right? Why we highlight this area is important because it's called a pullback resistance. Price react off 1 time, react off 2 times, react off 3 times, react off 4 times, right? So it's a nice little area over here. Okay, so this might be your trading strategy that I want to maybe buy when price reaches here. Then you throw in Fibonacci, right, to fine tune it. So you do a Fibonacci and like, okay, right, it happens to line up with a 50% retracement, right? I'm going to draw all the way from down up to here. You know, it could be a 38, I guess. Nope. Yeah, it happens to line up with a 50% retracement, as you can see over here, right? So I not only have a support level, I have a 50% retracement. Then I use this thing called Fibonacci projection. Maybe it's something that's a little bit more advanced that guys can use in the future. A Fibonacci projection, and it's like a 1 point, 2 point, 3 point. I realize 61.8 retracement lines up over here. So previously, what was just one support, one reason, I got 2 reasons, I got 3 reasons why price is going to bounce. Okay. And then from there, of course, now I have a higher confidence that this trading strategy will work. When price finally comes down to there, right? That will be my buy entry, right? And then price kind of takes off from there. Price makes that little bounce. Okay, but Fibonacci is useful for catching reversals, right? Fibonacci is useful when you combine it with other stuff, other indicators. And yes, Jeremiah, you can use Fibonacci with other indicators. You should be using Fibonacci with other indicators. Now, there's one last bit of parting advice I want to give you guys, right? When it comes to trading, always combine different studies together. Okay, always combine different studies together. Okay, what I mean by that, you don't want to come in here. You don't want to come in here and you go like, okay, I'm going to use a stochastic. I'm going to use a MACD. I'm going to use a RSI. Right, I'm going to use RSI. I'm going to look at it and I'm going to say all of it is telling me that, you know, maybe we go for like this example, right? Say, okay, all of it is telling me that it's overbought, right? And because of that, I'm going to sell, you know, I'm going to sell, right? This is just one indicator telling you the same thing 3 times, right? In a different way. So this gives you a false sense of confidence. So when you're combine indicators, you want to combine them across, you want diversity, right? What is diversity? Let's search for the word diversity, right? Diversity images, right? You look at this diversity, you got people of different nations, everyone together, right? It's not a single person, right? You got different, there's got a good amount of diversity there. When it comes to trading, you want diversity too. You know, you want to be able to use, right? In this case, you want to use support. After you use support, maybe you want to throw in an Ichimoku cloud. Probably not Ichimoku cloud. Yeah, but let's say Ichimoku cloud. After that, maybe you want to draw a trend line for support. However, you want to draw a trend line. After that, you want to use maybe a Fibonacci projection. After that, maybe you want to use a Fibonacci retracement. Fibonacci retracement from here to here. After that, you know, you kind of throw in different studies. That helps you get a more balanced view, right? It's the same way when you have a good idea, you don't go to your parents and say, hey, mom, is this a good idea? She'll be, yeah, son, that's amazing, right? That's amazing. Go ahead with it. Everyone will love it, right? You know that your mom is just telling you what you want to hear. So if you have a good idea, a good trading idea, run it by different studies, run it by different indicators, see whether it still holds true. If all of them are agreeing, right? So you show it to your mom, say, mom, this is a great idea. You're like, yeah, it's great. You show it to your dad, who is very critical, and it's like, yeah, that's a pretty good idea. Show it to your friends. Your friends are like, hey, it's pretty good, right? You show it to strangers. Strangers say, yeah, you know, it's not bad. Then you know you have a good idea, right? It needs to run it through different people, right, to get everyone's opinion. And that's how you kind of use Fibonacci to really fine-tune your trading strategy. Run it through, run it by different people. And, if all of it agrees, right, that it's going to bounce, then you have high chance that it's going to work. Not a 100% chance, but you got a high chance. Okay? So Jeremiah is asking, what is the best technical indicators to use Fibonacci? I tend to use the Ichimoku cloud, right? I tend to use support and resistance, right? Pullback, overlap kind of resistance. I use a little bit of candlestick, right? I use trend lines too. I use correlation, okay? Fibonacci itself, it's a lot because I use retracements, extensions, expansions, projections. Everything will be covering in the next 3 weeks, okay? All right, it's a lot of stuff that I'm going through today, right? But I do want to take this session to thank you guys for staying with me throughout this entire webinar, right? I can see almost 100% of you guys stayed all the way. If I can, right? Just give me, give me a second. I think we have no, we don't have a poll here. We were supposed to have a poll. Sorry, no. Okay, it's fine, right? Yeah, so thanks for staying with me throughout this entire webinar. I hope you found it useful. Bulo is asking, is Adrian Pang? I am not Adrian Pang, right? My name is Desmond Leong. For those of you guys who are not familiar with me, right? I just gotta go all the way back to here, right? Yeah, that's me, Desmond Leong, right? Please do not confuse me with Adrian Pang, right? All right, yeah. So yeah, please, tune in next week. All right, it'll be my team that will be taking you through the other webinars, right? If you may, right, in the future webinars, we're going to ask for feedback and reviews and stuff. But thank you so much for staying through this entire webinar, right? Yes, I forgot to tell you guys one thing, right? If you have access to your Vantage Vantage Markets client portal, right, there's this part called a VIP room, right? You can actually access the VIP room and get direct access to me, get direct access to the fellow team, right? And be able to practice your analysis there, especially Fibonacci, right? I'm glad you found it useful. Thank you, Rajesh. Thank you, Keen, right? Thank you, Amor, Bulo, right? Don Hutchinson, right? Really appreciate you guys staying through this entire session, right? Thank you. Remember, stay safe, trade safe, right? I'll catch you guys next week or the week after, right? Either be me or my team, right? But it's really fun having you guys. All right. The recording might be up. I'm not sure you need to ask Vantage for that. Okay. Now, guys, stay safe, trade safe. Peace out. Okay. Peace out, guys. See you guys. Bye-bye.